here at the firm, we do a lot of planning, not just for individual clients we work with, but also some of our institutional clients who rely on us for things like assumptions for inflation, assumptions for expected return for different asset classes. Given, for example, you manage IVOL, which is an ETF strategy, which is pretty unique. I'm curious to get your thoughts on, given all the federal stimulus, given all this collapsed yield environment that we're in, and given that yields are at generational lows, what should investors be thinking about, not just now, but going forward?
Yeah, it's a really difficult time to be a fixed income investor because government bonds are near their all-time, most expensive levels, with the 10-year currently at 65 basis points. So it's never been more expensive to own duration in the portfolio. And I think the risk reward has never been worse, even in, the super bull case scenario, if 10-year yields were going to zero, the most you could possibly make by owning long duration bonds is, 5 or 6%. Whereas if the market normalizes and we stabilize to like the equity markets already have and the credit markets already have, you can lose, 15 to 20% in price terms really quickly. And then if you look at the credit markets, obviously we had a huge credit sell-off in the first quarter. And then when the Fed stepped in to stabilize credit by buying credit ETFs, the market has completely normalized in credit. So credit spreads have tightened in the second quarter. And I think going into the third quarter, there have never, I think, been more challenges for investors, especially when you're looking at fixed income.